Bad operators don't just underperform, they lose your money, and sometimes all of it. And most people can't spot them until it's too late. I'm Dan Breezy, X Games gold medalist, co-founder of Granite Towers Equity Group, and most of the deals our team sees, we're gonna walk away from. And there's three things that tip me off every time. And you don't need to be a real estate expert to see them. You just need to know where to look. Let's get into the video. One of the biggest points you have to tune into as you guys are looking at investing in deals is what are the pro forma rent bumps and are they realistic for that submarket? Back in 2021 or even 2020, a lot of deals had 15-20% rent increases year one because at that time, that's really what the market was doing. But the reality is that was a short-lived period of time when inflation was very aggressive right after COVID. That time did not live. That time did not last. And so a really important part that you've got to be looking at every time you're looking at a new deal and looking at investing in a new deal is what is the rent bump increase percentage each year for, is it a 5-year hold, a 7-year hold, or a 10-year hold? Anything over 3%, you should be raising your eyebrows saying, how do you know that? Can you show me the data? And even if they can show you the data, whether it's CoStar or HeyGen or whatever site they're using, Yardi, it still may be wrong. So be cautious. If you see 5, 6, 7% rent growth, just realize that they have to get those numbers, that increase, per their projections, or those returns they're telling you they're going to get are not going to happen. So that's a huge, huge red flag right out of the gate is what are they using for pro forma rents? Other pieces is pro forma expenses. And oftentimes new operators will come in and have this beautiful view of how much they're going to reduce expenses as if the first operator couldn't do that or the current owner couldn't do that. And sometimes it is true. So I'm not saying it's not true all the time. There are times where you definitely can get an insurance reduction or utility reduction, but just be aware if you're seeing these huge expense reductions, just ask the operator, how are you going to do that? And how many times have you done it before? If you're looking at a deal, you guys, the way every sophisticated operator should be projecting what they're going to get at rent for their pro forma rents is based on the submarket. And the only way they're going to get that data is by secretly shopping the submarket competitors. Physically would be ideal because, physically when you're there, you get to see exactly what the amenities are like. How's the pool finished? How's the gym finished? How are the interiors compared to what we're buying? And then as the operator, the syndicator, the person marketing the deal, they need to be able to very clearly put together a business plan that will be able to match the interior, the exterior to be competitive in that submarket. And then, and only then, can you use rents that are being currently achieved in that submarket. So the way an operator is going to project the rent is purely through what the competitors are doing right now. And you want to be really cautious, you guys, too, of what's the 1 mile median income? What's the 3 mile median income of this tenant profile, right? If you're buying a property and the 1 mile median income is $30K and you're looking to get, $1,500 a month in rent, that's too much. You're not gonna be able to get that out of the tenant profile that's in that submarket. Whereas if you're in a submarket with 100 or 105,000 1 mile median income and rent's $1,500, totally different story. So you've really got to do an assessment of here, how many residents in this submarket can truly afford this rent. And if you don't know what 1 mile median income is, that means if you took all of the incomes, 100% of the people, and put them on a list in that submarket from the top to the lowest, it's the middle income. So when, distributions and investor returns are marketed, they're all shared, hey, this is what we're going to go get for you. But these aggressive rent growths or these projections are never actually hit. What that means is your returns are going down and distributions are going down, because in order to give cash flow distributions, they have to maintain their projected rent growth year after year after year and their expense, projections year after year after year, or there simply won't be any cash flow. So for an astute investor like yourself, as you're analyzing whether to invest or not invest in the deal, be really thorough on what that rent growth is per year for the first 5 years, for specifically the first 5 years. That's your most critical time. After that, it should be minimally 3%, maybe even 2.5%, depending on the market. For Dallas, we use 3%. CoStar projects 3% as organic rent growth. If we're going to do upgrades, you're going to see larger rent growth than that based on the submarket. But once you're stable, once you're looking at organic rent growth in a strong market like Dallas, 3% is max. And look, I know a lot of you are watching this at different stages. And for those of you that are just learning, that's great. Keep watching, grab the free blueprint, educate yourself. But some of you are past that. You already know this makes sense conceptually. You just need someone to look at your specific numbers and tell you what actually applies. That's what our capital positioning call is for. If you're an accredited investor and you want to have a conversation with my team about how your capital is positioned and what real estate could look like in your portfolio, we've got a few spots open this quarter. Links down below. Any operator that really believes in a deal is going to put their own capital in a deal. Like, I don't even invest in any other operators anymore because I would rather put everything I've got in the deals we're buying. Number one, it shows that I believe in the deal. Number two, I do believe in the deal. Otherwise, I wouldn't be buying it. So if you go to a firm and you can see that they're not investing any capital in the deal, you'd have to be asking, why is that? It should raise your eyebrows, and it might be a deal killer for you. Something that for me, if they're not putting any money in the deal, I'm just going to go ahead and walk away, because clearly they are not excited enough to put their own capital in the deal. Why would I be putting my capital in the deal? Another thing you need to watch out for, you guys, is fee heavy structures. It allows an operator profit through the acquisition and management fees, but it may sink the deal tremendously. If you see 3, 4, 5% acquisition fees on the front end, just realize that that is capital that is coming in from their capital raise that they are taking directly off the top and profiting from, which I'm not saying there shouldn't be an acquisition fee. I'm just saying be aware of those when you start seeing those large numbers. 1 or 2% is industry standard from my perspective for an acquisition fee, right? An asset management fee, 1 to 2% of monthly income. Property management, 3, maybe 3.5, 4%, depending on the size of the property. A due diligence fee, sure, $100, $125, maybe $150 per door. That's all standard. It's when you start to see these large fees where they're way beyond that, 3 to 5% acquisition fee, 3 to 5% asset management fee, 5 to 8% property management fee, due diligence fee of $350 or $400 per door. Those are red flags, and you got to be aware of them because they will add pain to the deal. I think about my snowboarding career, you guys, and there's a lot of coaches in the snowboarding industry that do not know how to do a trick. They've never hit the jump, but they sit there on the sidelines telling the athlete how to do it. I always found that interesting, and quite frankly, I had a hard time ever listening to those coaches. Whereas the coaches who I knew who have done these tricks over and over and over again, not only can they watch and give you perspective, but they have an internal feeling of what that feels like. If I'm looking for a mentor, or I'm looking for an operator that I'm looking to invest my capital with, 100% of the time, I'm looking for somebody who is doing it and doing it successfully over and over again. That doesn't mean that if they've had a bad deal or a couple bad deals and they've been around for a decade, that I'm writing them off. In fact, if they've had a couple bad deals and they're still here, I'm more excited and have more confidence in them because they didn't go run to the hills. I can say with certainty, you guys, that there were a lot of operators around in 2020 and 2021 that are no longer here. They're gone. And so for the people that are still here today, they've had probably 3, 4, 5, 7, 10, 15, 20 deals, depending on how long they've been going, that have been great. And then they bought some in 2021 and 2022 that it doesn't matter how great you operated them, they're probably not doing that well based on the timing of the market cycle. I can tell you with certainty, if that group is still here, they have learned a ton. They have evolved a ton, and they're a totally different group than they were back then. So for me, looking at, hiring or investing with people is, have they done it before? Over and over and over again? Have they had some successes? Have they had some failures? Are they still here, and are they committed? When you're looking at a deal, you guys, they should have a stress test tab, or they should have a stress test page showing you if cap rates rise, what will your returns be, right? If occupancy drops to 90, to 85, to 80%, what will your cash flow be? Whenever you're buying a deal, you always have to be stress testing the deal, right? Because you're investing. You got to know what you can handle. What will the deal be able to withstand? How much CapEx reserves do you have as completely emergency money, just in case after your thorough due diligence inspection, something still comes up? And so a big component to analyzing a deal is a stress test page. So if you're looking at a deal, considering investing in a deal, look at their stress tests that they're giving you. They should show you what the cash flow is if they drop in occupancy, and they should show you what your exit returns are if cap rates do rise. For me, you guys, if an operator has had a challenging deal or two and they're very open about it, it tells me that they're very honest human beings, right? They're not here hiding things. I've been around a long enough time. We own 3,000 units, right? We've done almost 30 deals, coming on over a decade of ownership. I know that if you're in the business long enough, you're going to have some challenging deals. That's with certainty. Like, I've talked to operators who are far further along than me, who have far more units, and 100% of them have had deals that have been challenging. You're not going to get out of this business without some challenging deals. So if you've only had success, or you're telling me you've only had success, either A, you haven't been in the business long enough, or B, you're lying. And so when I can see, hey, you're being honest about a deal that hasn't gone well. What did you learn? You're still here, right? You're still pushing. You still believe in the future of this asset class. That is invaluable, is absolutely invaluable. Be chasing folks who have had many successes and who have had challenges, and will tell you everything they learned in those challenging deals, because that's the gold. If you guys are looking at a deal, you're going to see some of these characteristics when you're finding a great operator or a great deal. Number one, you're going to find a pretty low leverage fixed debt likely in place. Talking 60, 65, maybe 70% leverage. They're going to be raising their CapEx liquid, right? They're not going to finance their CapEx and over leverage the deal. So a big characteristic right out of the gate is, what is the debt and how much leverage? If the leverage is 80, 75 to 80, 85%, you should be throwing red flags up saying, hey, is the deal only working because it's leveraged to the gills? Another huge thing you should be looking at, and I talked about it earlier, is the projected rent growth. Like, what is the real projected rent growth? And there might be a big gap year one, because an asset might have a lot of deferred maintenance, it might be poorly managed, it might need upgrades to match the submarket. That's one thing. But once they get past that stability in their value add strategy, what are they using for projected rent growth for the next 3, 4, 5 years? Anything above 3%, I'd be cautious. I'd be looking at. Anything 3 and lower is really solid. And that's in a really strong market like Dallas with major job growth and population growth. Another one is vacancy. What is the economic vacancy they're using? Anything under 10%, even in extreme pent-up demand markets, can be aggressive. If you're using anything under 10%, because when you're taking economic occupancy into place, you're taking your physical occupancy, you're taking your bad debt, you're taking concessions, loss to lease. There's so much that goes into it. So if you got anything under 10%, I'd be very cautious, very concerned. There's some submarkets that we do invest in where we might use an 8 or a 9. And these are in markets where we've had literally so much pent up demand that we've never had a vacancy. Like, it is literally 100% vacant and there's no new units coming. Probably be a great opportunity for someone to build. I'm not going to share where that is because that would affect our business plan. But the leanest you should ever see is 8 or 9%. And those are in markets where you just don't have any supply and it's 100% occupied. Other great things is expense growth. Are they using 3 to 4% expense growth? Because realistically, in an inflationary environment, you're probably in that range, at least, maybe even 5% expense growth. Another thing to be looking for is your exit cap rate. It's an interesting time right now because even though cap rates have risen quite a lot, as interest rates rose, you still would love to be able to use an exit cap rate that's 50, 75, or 100 basis points higher than what you're buying at. Anytime you see an increased exit cap rate by 50, 75, 100 basis points, that's very conservative. And the cap rate is going to change tremendously, you guys, based on your submarket, based on your asset class, right? If you're buying a 1970s deal in a very small town in New Mexico, you might be at a 12 or 13 cap. Or if you're buying a newer asset in a prime location around Dallas, you might be at a 5 or 5.5 cap. So that's another piece just to be aware of, is that cap rates change tremendously based on location and year built of the product. It doesn't necessarily mean higher cap rate, better deal. That is definitely not how it is. It means higher cap rate generally means more risk. Lower cap rate usually means lower risk. Most operators aren't lying to you. They're just using poor projections and they may not even know it. And your capital pays the price. The people who protect their money, they're not smarter than you. They're just willing to ask the uncomfortable questions at these times. So they read the assumptions before they read the returns. That's who you are now. Trust the math, you guys, not the story. If you want to go deeper on this, watch this video next. It breaks down exactly how the structure works.